Hello, welcome. So now let's look at IFRS 13 fair value measurement. IFRS 13 fair value measurement. Okay, so I'm sure you are familiar. Most times I know that you have been hearing fair value, fair value. In fact, most of the standards and IFRS we are going to be looking at together, you're hearing a lot of fair value. Measure it at IFRS, which is measure non-current asset for sale at the lower of carrying amount and fair value less cost to sell. So fair value, so fair value. So let's look at in very detailed terms now what is fair value and how do we calculate fair value. So the standard that deals with fair value is what? IFRS 13 fair value measurement. All right. Now let's get into it. Now, some IFRS require or allow entities to measure or disclose the fair value of assets, liabilities, or their own what? Equity instrument. Now, some of these standards contain little guidance on the meaning of fair value. Okay, so in those standards, you hardly find, like we've done IFRS 5. So when you look at IFRS 5, you notice that we didn't mention what fair value is or how to definition of fair value. It says now others contain guidance, but this was developed over many years and in a piecemeal manner. So what are we trying to achieve with IFRS 13? What's our purpose? One, since IFRS 13 is one to define what is fair value. Two, set out a single framework for measuring fair value. Then specify disclosures about fair value what? Measurement. So we're going to look at three things under IFRS 13. One, what is fair value? Two, what is how do we measure fair value? A single framework of measuring fair value. Then what are the disclosure requirements? What are the things we are supposed to disclose about fair value in our what? Financial statement. It says now, please note that IFRS 13 does not change what should be fair valued nor when this should occur. That's why most times say that IFRS 13 is more of a theoretical standard. Please, IFRS 13 is not the one that will tell us how each item should measure fair value. For example, IS 16 or okay, let's say IS 16 now. So you know we have the cost model and revaluation model, what you call fair value model. So please, now is each standard itself that will tell us in specific terms how they want us to actually measure what? Fair value. Our own job, our own work is to what? Is to, in IFRS 13 is just to set out a framework, like normally, generally, how should we measure what? Fair value. Please remember that it's each standard that will tell us in specific terms how it wants us to calculate is what? Fair value. Now, let's look at scope limitations. What are the areas that are not covered by IFRS 13? It says now, IFRS 13 does not apply to share-based payments transaction within the scope of what? IFRS 2. IFRS 2 is, don't worry, it's not for the skill stage is for what? Professional stage. So for those doing professional, when you get to professional stage, we'll do that. Then measurements such as net realizable value, IS2 inventory, or value in use, IS36, have some similarities to fair value, but they are not fair value and they are outside the scope of what? IFRS 13. So when it comes to inventory, that's outside the scope. Then impairment of assets under IS36 is not within the scope of what? IFRS 13. The IFRS 13 does not, the disclosure requirement do not apply to the following: plan asset measured at fair value, IS 19, that's for professional stage. Retirement benefit plan investment measured at fair value, also professional stage, IS 26. Asset for which recoverable amount is fair value less cost of disposal in accordance with what? IS 36. Now, very important, pick your books or writing materials and write this down. What is fair value? Let's get the definition of fair value. What is fair value? It says now, fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. I'll come again. Fair value is the price. Please know that fair value is price. Is the price that will be received when you are selling an asset or paid when you are transferring a liability in an orderly transaction between market participants at the measurement date. Know that in bracket says it is an exit price. So I'll use the exit price to explain how you can best get and know this definition, that you don't have to memorize it. Now, it says fair value is the price. Now, fair value, we're going to look at fair value from two perspectives. One, the perspective of an asset and the perspective of a what? Liability. Now, when we say fair value is the price that will be received to sell an asset, that means when it comes to assets, when we want to fair value assets, what do? We look for the price that we will sell the asset. That means it is what? The asset is going out. Exit price means that something is going out. So when it is assets, we are selling. When it is a liability, we are transferring the liability. So please, for assets, fair value is what? The price you will sell the asset. Remember exit, so going out, not buy. Please sell. For liability, the price will what? Transfer the liability. Then in an orderly transaction between market participants at the measurement what? Date. So now we're going to look at more details about the definition as we move on. This now. Now, comment. This definition emphasizes that fair value is a market-based measurement, not an entity-specific what? Measurement. So please note that when we are looking at fair value, fair value is what? Market based. We get our value from the what? Market. Remember, I said if it's an asset, we are what? Selling. If it's a liability, we are what? Transferring in the market transaction. So please note that fair value is what? Market based. In other words, if two entities hold identical assets, these assets, all other things being equal, should have the same fair value. And this is not affected by how each entity uses the asset or how each entity intends to use the asset in the what? Future. All right, so we're saying that now, if two entities hold assets and now all other things, the asset being equal, they should have the same value. What do we mean by that now? Let me take a practical example. If entity has a Toyota Corolla 2005 model, entity B also has the same Toyota Corolla 2005 model. Are we together? All right, now, please note that if you want to fair value the assets, all other things being equal, regardless of how each entity uses the assets, the fair value should be the same, because normally the value that we will sell a Toyota Corolla should be the same, assuming that we're using the same market. So if I go to market A, I want to fair value the Toyota Corolla for company A, they say it's 3 million naira. If I go to the same market, I want to fair value Toyota Corolla from company B, it's still going to be what? The same price. Okay, now, an entity must use the assumption that market participants will use when pricing the asset or liability under current market conditions when measuring fair value. That's what we call orderly transaction, meaning that we must use assumptions that market participants, that is, we will assume that it is what is happening in the market that we're going to use to judge. There are no related party transfer. That means there's no bias or there's no special treatment. So I'm going to use like a normal buyer and seller in the market. For example, if the same Toyota Corolla I want to fair value, I want to sell to maybe a friend. Friend can be like, give me discount now. You know I'm your party. Let me pay 2.8 instead of 3 million naira. So that's an example of what? That's not an orderly transaction. Why? Because it is not what? It is not assuming that this is a market condition. So please, that's what I mean by orderly transaction. Then please write this down. It has come out like once or twice. Now, market participants are buyers and sellers in the principal or most advantageous market for the asset or what? Liability. So who are market participants? These are buyers and sellers in the principal or most advantageous market for the asset or liability. So those that buy and sell in the market are called what? Market participants. Now, please write this down. Very testable in the exam. You hear things like, okay, can come out like, what are the characteristics or qualities of a market participant? So let's look at them. There are three. One, they are independent of what? Each other. Like I said, they are not related to each other. They are like just normal market participants. There's no bias or there's no level of subjectiveness in the word transaction. Two, they are knowledgeable. That means they understand and know about that particular what? Asset. Then three, they're able to enter into a transaction for the asset or what? Liability. They have the ability to enter into transaction for that particular asset or what? Liability. Okay. So now, those are what? Market. So I'll come again. What are their qualities or characteristics? One, they are independent of each other. They are knowledgeable about the asset or liability of the market. They have the ability to enter into a transaction for the asset or what? Liability. So once they have those three characteristics, we call them what? Market participant or qualities. All right. Now, let's look at what we call fair value at initial recognition. It says now, in most cases, the price paid for an asset is what? Fair value. So we're saying that in most cases, the price you pay for an asset is the fair value of the what? Asset. What do you mean by that? Remember I said that for assets, what did I say the definition of fair value was? Fair value is the price that you will sell an asset, not buy. Now, what we are saying here is that now, for most assets, now, in normal markets, when you go and sell an asset, the buying price of an asset is the same thing as the what? Selling price under normal conditions. Let's say I want to go and buy a laptop, HP Pavilion laptop in the market. Now, if I get to the market and I say I want to buy this laptop and they say it's 800,000 naira, hypothetical example. Okay, I say great, give me the laptop. If I want to sell that laptop to, normally, how much will I sell it at that same day, at that same time? 800,000, because that's the value in the world in the market. So we're saying that for most assets, in on initial recognition, the first time we are recognizing it, the fair value of the asset is also going to be the cost of the asset, because at that point in the market, the buying and selling price under normal conditions should be the what? The same thing. That's I said under normal conditions. But now you have some special forms of assets that on initial recognition, the amount you buy it might be different from the fair value. Remember I said fair value is the what? It is the price you will sell an asset. Now, there are some assets that the buying price and the selling price is actually different, and there are reasons why they're actually what? Different. And please remember that for those kind of assets, I said when you want to fair value, what do you use? Use your what? Selling price. Let's take an example now. Let's say that we have an asset. Good. Now, an asset like that is foreign exchange. If you want to buy dollar, or you want to buy pounds, or you want to buy foreign exchange. Now, when you want to get foreign exchange or foreign currency, now you know that the price they will quote for buying is different from the price they will quote for selling. If I want to sell a dollar, they can say that they will I can sell the dollar in that market for, let's say, 1,400 naira per dollar. And if I want to buy that same dollar that I've sold, they can say they are going to sell it for me what? 1,600 naira per what? Per dollar. You can see that now the buying price is what? 1,600, while the selling price is what? 1,400. So they are different. That means if I want to fair value that currency on that day, which value am I going to use? Remember I said assets, what do we use? We use our selling price. So the fair value is going to be what? 1,400. But how much did I actually buy it? 1,600. That's the buying price. Now, if a standard now say that I should use my selling price as my what? As my fair value. You know that how much they actually pay for the dollar? I paid 1,600. But if I want to sell, how much am I going to use? 1,400. That means I have to recognize that at what? 1,400. So what am I going to do? I'm going to calculate a gain or loss. Have I made a gain or loss on that asset? Now let's look at it together. An asset that I will sell for 1,400, I bought for what? 1,600. Automatically I've made a loss on disposal of how much? Of 200 naira. Because normally what I am recognizing it at is lower than what I actually paid for it. So that's what we call fair value at initial recognition. So we're saying that don't worry, we're still going to look at the practical example of this when we start looking at some other standards in details like financial instruments and lease. We'll look at how is it possible to have gain or loss on initial recognition. So we'll look at this in more details when we get to that. All right, great. Now let's look at how do we measure fair value in our financial statement. Now, fair value measurement assumes that the asset or liability is exchanged in an orderly transaction between market participants to sell the asset or transfer the liability under current market conditions. Now, however, in each case, fair value measurement looks at the asset or liability from the point of view of who? A market participant. Remember, I've told you who a market participant and their qualities now. The fair value must take into account all factors that a market participant will consider relevant to the value. So when we are measuring fair value, what are the factors we consider? One, you can write this down. Factors to consider when measuring fair value. One, the condition and location of the what? Asset. Two, restriction if any on the sale or use of the what? Asset. So we're going to look at one. What's the condition and location of the asset? Is there any restriction on sale or use of the asset? So those are qualities. Now, for example, if I want to go and fair value a car, I want to buy a car. What are the things I will look at? Of course, normally I'll look at one. What's the condition of the car? Is it still in good condition? That will affect the price I will sell or buy the car. Then secondly, is there any restriction? Okay, does it have all its papers? Do you still have to do some other legal things to make it? So those are the things that also affect the price of that asset. Now, please, good. Now let's go to another very testable area in the exam. Please pick your book, your biro and paper and write this down. Your writing materials, your notes. Now, IFRS 13 defines an active market. Now, we're going to look at types of market. We have three major types of markets when it comes to IFRS 13. We have active market, we have active market, we have principal market, we have principal or most advantageous market. Okay, now let's go. What is an active market now? So write down the first market we have is what? Active market. An active market is a market in which transaction for the asset or liability takes place with such frequency and volume to provide pricing information on an ongoing basis. I'll come again. An active market, write this down please, write this down, is a market in which transaction for the asset or liability takes place with such frequency and volume to provide pricing information on an what ongoing basis. Let me explain now. Please, that means an active market is a market in which that transaction, they are buying it. Frequency means the number of times they are buying it. Volume means that they are buying it in enough quantity that at any point in time you can determine fair value in that market. So that means an active market is a market where if I go to the market, one, I'm going to see that they are buying and selling that asset I want to go and fair value. In such what frequency, that means they are buying it like the number of times they are buying it is more than like frequently they buy frequently. Then they are buying it in such volume, number of volume of times they are buying it, that you can determine what pricing information of fair value anytime on an ongoing what basis. An example, an active market for shares of Nigerian companies is the what? Nigerian Stock Exchange. Why? Because anytime you get to the Nigerian Stock Exchange, you know that they are always buying and selling what? The shares of what? Nigerian companies that are quoted there and other companies too. And they are buying it in such frequency and volume that at any point when you get there and say, I want the price of the shares of Zenith Bank PLC, you will what? You will get the price. That's what you call what? Active market. It says now, if an active market exists, then it will provide information that can be used for fair value what? Measurement. So please, anytime we have an active market, that's where we determine our what? Fair value. It says now, if there's no such active market, e.g. for the sale of an unquoted business or surplus machinery, then a valuation technique would actually be what? Necessary. Now, a quoted price in an active market provides the most reliable evidence of fair value and must be used to measure fair value whenever what? Available. So please, the preference or the market that we first look for when we are calculating what? When we are calculating our fair value is what? Is the word active market. Now, it will be unusual to find an active market for the sale of non-financial assets. So some other sort of valuation technique will usually be used to determine what their fair value. Now, let's look at what we call principal or most advantageous market. Now, I've explained active market. Let me come again. Active market is a market where the transactions for the asset is they are trading the asset in such frequency and volume that you can determine fair value on what? On an ongoing basis. Now, let's look at the next market. Write it down. Principal market. Now, it says now, fair value measurement is based on the possible transaction to sell the asset or transfer the liability, either in the principal market for the asset or liability, or in the absence of a principal market in the most advantageous market for the asset or liability. Now, what's a principal market? Principal market is the market with the greatest volume and level of activity for the asset or what? Liability. So we're saying that principal market is the what? The market with the greatest volume and level of activity for the asset or what? Liability. Please write it down. Principal market is the market where they are selling that asset in the greatest volume and level of activity. That means if you have like 6 different active markets, the market where they are selling it in what? The greatest volume, that is, they sell it the highest. Everybody knows that this is the market where they sell this thing in the highest volume. And secondly, the level of activity, that is, the way they trade the asset is very what? Is the highest. That is your principal market. Please, we'll still look at an example. In the exam, they can give you like 5 or 6 different markets and tell you to identify your what? Principal market. How do you identify your principal market? Very simple. Your principal market will be the market where they are what? Where they will give you the level of activity and the volume of transaction. They can give you market A, level of activity is 5,000, volume of transaction 3,000. Market B, level of activity 10,000, volume of or frequency of transaction 15,000. Please, the market B will be our what? Principal market. So just look for the market that has the what? The greatest volume and level of activity. That is your what? Principal market. Now, the last market, most advantageous market, says now, the most advantageous market is the market that maximizes the amount that will be received to sell the asset or minimize the amount that will be received paid to transfer the liability after taking into account transaction cost and what? Transport cost. So I say most advantageous market is the market that what? The market that maximizes the amount that will be received when you are selling the asset or minimizes the amount that will be paid when you are transferring the liability after taking into account transaction cost and what? Transport cost. So please, let me explain that in very simple English language. Most advantageous market is the market where you are going to get the highest amount of net cash received That is the market that when you sell, you are going to make the most money in terms of cash that you will take home. Please know the word cash that you will take home. That means it is the market that after you have removed all your costs, the market that will give you the highest amount after you have deducted all the expenses you have spent. And we have two expenses under fair value. That's transport cost and what? Transaction cost. That's what we are going to look at next. So please, most advantageous market is the market after you have removed your transport cost and your transaction cost, you have the what? The highest net amount received. That's the word you will use in the exam. So please, the highest net amount received is what is the most advantage. Let me take a practical example. The market that you go to, now when you sell, the money you are going to take home in your pocket is the highest. It's called most advantageous what market. So that means if in market A, I go and sell in market A, and I'm taking 50,000 home. Market B, I'm taking 70,000. And market C, I'm taking 150,000. Which one is my most advantageous market? Market what? C. So that's what you call what? Most advantageous market. Okay, now note that if there's a principal market for the asset or liability, the fair value measurement must use the price in that market, even if a price in the different market is potentially more advantageous at the measurement what? Date. So what is saying is that please, for a principal market is saying that, so what we're trying to say there is that please, there's a priority to market. When you are measuring fair value, you first look for a what? Principal market. That is the market they are selling it in the highest level and volume of what? Activity. So that's the market you are going to use. It's only if you don't have or cannot identify a principal market, that means all the market they are trading almost at the same volume and frequency, and we cannot identify one that it is what? They are traded at the highest amount. That is when we will use our what? Our most advantageous market. So please, there's an order or a priority. The first thing we look for is there a principal market. If there's a principal market, we measure fair value in the principal market. If there's no principal market, that is when we now consider our what? Most advantageous market. So please, I've explained in very clear terms the three types of markets we have. I said we have what? Active market, principal market, and most advantageous market. Like I told you, these are very testable areas in the exam. The areas the examiners like testing students on their understanding of this basic concept under what? IFRS 13. Now let's look at, before we go to the board and solve computational questions on IFRS 13, let's look at one or two more. Let's look at what we call transaction cost and transport cost. Very important when you are measuring fair value. You have two costs, type of cost when you are measuring fair value. You have your transport cost and transaction cost. I'm going to tell you how you are going to use both when you are calculating or determining your fair value, in case you have questions like that in the exam. In the exam too, they can ask you what is transport cost and transaction cost, and how do you treat this when you are calculating or determining fair value. Now let's start from transaction cost. The price in the principal or most advantageous market used to measure fair value of the asset or liability is not adjusted for what? Transaction cost. Transaction cost are the costs that you will bear when you are selling the asset in the what? In the market. For example, if you are going to pay a particular levy or tax, I want to go and sell something at Computer Village, and if I go to Computer Village, I have to pay a particular levy or a tax before I can sell the asset. That's an example of a what? A transaction cost. So cost that you incur in the market when you are selling the asset is called what? Transaction cost. So please note, write it down. Please, transaction cost is not relevant for determining fair value. That means when we want to calculate fair value, we ignore or we don't use our what? Transaction cost. Please, I'm saying it again, write it down. Transaction cost is not relevant when you are calculating or determining what? Fair value. Okay, says now fair value is not net realizable value or fair value less cost to sell, and using the price that an asset can be sold for as the basis for fair value does not mean that the entity intends to what? Sell it. So please, we don't use transaction cost. So if they give you transaction cost in the exam and they ask you to calculate or determine fair value, you don't use your what? Transaction cost. Very important. You know I'm saying it. Please write and note it down. All right, no problem. Let's look at the second one, transport cost. Now, if location is a characteristics of the asset, the price in the principal or most advantageous market is adjusted for the cost that will be incurred to transport the asset from its current location to the what? To the market. What we're saying is that now, if that asset, we have to transport it or move it from one point to the other, that means we have to move the asset from where it is to the market. That means we are going to bear transport cost. For example, those that are into farming, they want to go and sell ewedu, or you want to go and sell maybe pepper. You've just harvested pepper from them, you want to go and sell. You have to move from the farm to the market. That's what we call transport cost. Please, transport cost is relevant when you are calculating or determining what? Fair value. That means we are going to consider transport cost when you are what? When you are determining what? Fair value. So I will come again. Very importantly, I said transaction cost is ignored while you remove or deduct transport cost when you are calculating what? Fair value. So we are going to go to the board now and we are going to solve a computational question on what? On how to calculate fair value, because it comes out in the exam. So the exam for IFRS 13, either they ask you to calculate fair value or they ask you a theoretical question on what? On fair value. Then we also have practice questions that I've given you that you can try your hands on after we're done with this this standard. So you can try your hands on it and see whether you understand what IFRS 13. All right, great. So thank you. Let's get to the board.